This week on the agenda, shifting gears. Are Trump's tariffs driving the global auto sector down a dead-end street?
China has become the world's largest auto exporter.
$9,200 equivalent U.S. dollars.
Chinese automakers are going to come here eventually, and they're going to do it regardless of if there's a tariff or not.
In the shadow of the trade war between China and the United States, high tariffs, mutual sanctions, and tariff walls, it has long been a matter of curiosity how global companies will position themselves. US President Donald Trump was counting on one thing when he used the trade war as a trump card. Companies would be scared and forced to invest in the US. Today, however, the tables have turned. Despite Trump's tariffs, giant multinational companies, including Toyota, are turning their backs on the US and making huge investments in China. But recent reports point to an unexpected development, especially on the front of Japan's giant automotive industry. Many thought that President Trump's tariff hikes on automobile imports and his calls for manufacturing in the US would lure Japanese manufacturers to the US. However, we are faced with a completely different picture. Japanese giants such as Toyota and Nissan are choosing to make bigger investments in China instead of the US. And they are not just waiting. They are openly declaring, almost defiantly, that they are giving up on the US. Trump did not expect this. But there is a new reality. Multinational giants are making China their second home. So how did this revolt begin? Why did Toyota leave the US and head to China? And what will be the impact of this new trend on the global economy? Let's analyze the developments step by step. Before we begin, don't forget to subscribe to our channel, turn on notifications, and join our live broadcast to be informed about the latest and most critical developments as quickly as possible. Since 2018, the Trump administration has imposed heavy tariffs on many countries, especially China. The goal was simple: protect American manufacturing, increase the flow of investment into the US, and corner competitors like China. In practice, however, the result was something else. Companies started to look for new ways to overcome this pressure. Toyota is the clearest example of this. At first, Japan's leading manufacturers seemed to shy away from the situation, but the rising tensions caused by the tariffs forced them to choose whether to produce more in the US or to look for other markets. Toyota's decision to invest a massive $2 billion in Shanghai is a concrete answer to this question. The growth potential of the Chinese market and government incentives for electric vehicles make this investment attractive, the company's management said. Trump's increased tariffs or threats of a trade war do not seem to have changed the direction of this decision. Multinationals are pledging huge investments in China in defiance of Trump's trade wars. The $2 billion deal between Toyota and Shanghai shows that foreign direct investment is still flowing into China despite the trade war with the US. Unlike most foreign companies that adopt a wait-and-see attitude in a turbulent trade environment, this giant step represents the stance of bold multinationals that aim to expand their presence in China despite growing challenges. In late April, Toyota, the world's largest automaker, announced that it will invest in China in a new project that will focus on the production of Lexus-branded electric vehicles and EV batteries. Toyota will allocate a total of 14.6 billion yuan for this new energy vehicle, NEV, project, which aims to support China's green and low-carbon development goals. Construction is scheduled to begin in June, with production to start in 2027. This is one of the largest new foreign investments announced in China since Trump launched a barrage of tariffs. It has also been hailed as a sign of confidence in China, despite intensifying tariff headwinds. The automotive sector is also undergoing a major transformation, with Japanese automotive giant Toyota setting up a new project in Shanghai. This move is not only an individual investment, but also signals a potential recovery in US-China trade relations in the automotive sector. Toyota's decision to establish a new project in Shanghai is a clear indication that trade relations between the US and China are improving. This move is likely to stimulate the flow of automotive parts and vehicles between the two countries, creating new opportunities and challenges in the logistics sector. However, in the days leading up to the announcement of this deal, reports intensified that the US was pressuring its trading partners to limit trade with Beijing in order to be exempted from tariffs. However, giants like Toyota are not bowing to this pressure and are making strategic moves in favor of China. Toyota announced in February that it would initially aim to reach an annual production capacity of 100,000 units and create around 1,000 new jobs. According to Tatsuro Ueda, Chief Investment Officer of Toyota Motor, China, this project in Shanghai will be an important model, developing pioneering technologies that support carbon neutrality both in China and globally. Toyota also signed a separate 236 million yuan investment agreement for a hydrogen fuel cell joint venture with a partner in Sichuan. Despite US tariffs and trade uncertainties, the Japanese giants don to want to miss China's growth potential and leadership position in the electric vehicle market. Therefore, they are trying to strengthen their positions with strategic investments. In this sense, Nissan, another Japanese automotive giant, is taking a big step to strengthen its position in China. The Chinese chief said the company aims to reverse the sharp decline in sales by launching around 10 new energy vehicles in the coming years. Nissan was only able to sell less than 700,000 vehicles in China in 2024, less than half of its sales 4 years ago. The company was forced to lower its global sales forecasts due to this contraction in China. To change this picture, Nissan will invest a new $1.4 billion and plans to introduce 10 new models by the summer of 2027. In addition, the goal of launching 8 new vehicles by the end of 2025 will be completed earlier than planned. This wave of investment initiated by Toyota is not limited to Japanese giants. Many global giants are also taking a clear and open stance on investing in China. Nissan, similarly, says that it has started to focus more intensely on the Asian market due to uncertainty in the US and opportunities in China. There is no "let's completely ignore the American market" attitude across the Japanese automotive industry, but there is a growing sense that if we were to invest now, it would be in China. This may suggest that President Trump's policy of high tariffs will lure the Japanese to our soil has backfired. This is because Japan is driven not only by tariffs but also by the changing dynamics of global trade flows. China offers incentives for electric and hybrid vehicles, a huge domestic market, and a rapidly growing middle class. Moreover, logistics and supply chains are also strongly woven around China. When Japanese companies want to expand their share in this ecosystem, they look to China rather than the US. Of course, there are examples beyond automotive. Global giants such as Siemens, BASF, and Volkswagen continue to make massive investments in China despite tariffs. Some analysts say these companies see the trade war as a kind of noise and see the Chinese market as vital to their long-term strategy. They reject the wait-and-see approach and say tariffs are temporary, China is permanent. While President Trump has reiterated that we will balance any country that grows against the US, decisions are being made differently in the boardrooms of multinational companies. It is more profitable to capitalize on state support and the enormous demand in China than to go to the US and risk tariffs. Toyota's announced investment of $2 billion, Nissan's allocation of $1.4 billion, Volkswagen's establishment of an innovation center at a cost of $2.5 billion, Tesla's plans for a Shanghai megapack factory. All this calls into question the validity of Trump's thesis. With tariffs, I forced foreign companies to choose us. At the outbreak of the trade war, it was frequently stated that Japanese companies would be forced to produce more in the US. But now, Japan's giant automotive industry, Toyota, Nissan, Honda, has announced that they have chosen China for many of their investments. Economists say manufacturing in China means instant market dominance there. Moreover, regional supply networks facilitate exports. On the one hand, there is a chance to open up to Southeast Asian countries. If you manufacture in the US, high wages, uncertain policies, and the contradictory effects of tariffs await you. Japanese officials, on the other hand, may think that they can take these decisions without running afoul of the Trump administration, and that the risk of losing the US market is not that high anyway. Because the American consumer demand for Japanese cars is not going to end easily, and even in the worst-case scenario, Japan can find other ways to continue its trade. Japan's choice of China over the US is understandable, but at the heart of the matter is the commercial answer to the question, which is more advantageous? It can be expensive to invest in the US because of tariffs, and no one knows how long these tariffs will last. China, on the other hand, protects its own companies. But foreign investors can find great incentives, especially in areas such as technology and electric vehicles. If Japanese brands bring their experience in hybrid and electric cars to the Chinese market, their sales could increase exponentially. Although President Trump has said, "We will stand up to actions in the automotive industry that are not in our national interest," there seems to be no de facto mechanism to stop Japan. Additional tariffs, quotas, perhaps diplomatic pressure, but none of these seem to have the power to disrupt Japan's long-term plans for China. How does this development resonate with the US public? Some say, we have turned global trade in favor of China. We failed to create an attractive environment for Japanese companies when we told them, produce here. We raised tariffs and created uncertainty. So they went to China, criticizing Trump's policies. Others say, the Japanese would look after their own interests under any circumstances. Let us look after our own interests. It's not a big loss if they don't come. However, many parts and technology suppliers in the American automotive industry wanted to continue doing business with Japanese companies. Now, this supply chain will partly grow in China. This will further distance the US from its share of the automotive manufacturing ecosystem. Another striking dimension is that brands such as Toyota and Nissan will produce vehicles under the export from China to the world model and ship them to Latin American, African, or Middle Eastern markets. This further weakens the hand of American manufacturers in global competition. The question of whether the US has gained anything from the trade war comes up again. Volkswagen has started construction of a new $2.68 billion innovation center in China. Volkswagen Group China announced that this center in Hefei will rapidly increase local innovation power and bring developed technologies to market 30% faster. Tesla is increasing its investments to double the production of its gigafactory in Shanghai. It is also building a $201.76 million energy storage facility for its Shanghai megafactory. Apple is still heavily dependent on China, even as it seeks to expand its supply chain to Vietnam and India. Meanwhile, foreign companies from Germany and the US are also pledging to increase their investments in China. On April 3rd, Siemens Healthineers signed an agreement to build its sixth global and China's second-largest distribution and innovation center in Zhengzhou. And German chemical giant BASF announced a 500 million yuan expansion of its Telasto plant in Pudong, aiming to increase capacity by nearly 70% by 2027 and provide noise and vibration solutions for China's booming electric vehicle sector. BASF Vice President Xu Yibin said this is the company's first technology production base in China. Companies are no longer saying, let's wait and see what happens. They are making direct moves. This is because China is still the world's largest consumer market, technology and manufacturing hub, and the engine driving global growth. It should also not be forgotten that the electric vehicle market is a turning point. China aims to be the world's clear leader in electric and hybrid models, which it calls new energy vehicles. In this process, it is aimed for the market to reach giant dimensions by encouraging foreign investment as well as supporting domestic brands. Japan, on the other hand, has a lot of experience in electric vehicles with its Toyota and Nissan brands. When the strategic interests of the two sides meet here, it may have made more sense to build in Shanghai or Beijing instead of building a huge factory in the US. This kind of narrative can already be read in official statements. As electric vehicles grow rapidly in China, we want to be at the center of this transformation, Toyota executives often say. In the American press, the questions, then what about tariffs in the US? How will the US market be won back? Remain unanswered. Because Toyota is throwing the ball away by saying, of course we care about the US, but we will make our new investments mainly in Asia. The US, on the other hand, has taken some measures to prevent this shift of companies. Additional tax pressure on Chinese investments, new regulations on products imported from China, huge incentive packages to attract investment to the US. But for many companies, pressure and incentives are not enough. The risk of losing the Chinese market outweighs Trump's tariffs. For example, Tesla risks being wiped out by local competitors like BYD if it doesn't ramp up production in China. Toyota could be left behind in the electric vehicle revolution unless it gains traction in the Chinese market. So Trump's tariffs did not scare companies. On the contrary, they made them hug China tighter. On the other hand, although Asian stock markets were mixed due to US-China trade uncertainty, Toyota's impact lifted Japanese markets. On Monday, Toyota shares surged 5.5% on the prospect of acquiring major parts supplier Toyota Industries, sending the Nikkei 225 index up 0.5%. Nissan and Honda shares also gained 2.5% and 1.2% respectively. In contrast, Chinese stock markets remained muted amid uncertainty over the US-China trade talks. This trade war between the world's two largest economies has the potential to lead to a widely reverberating recession in the US. At the same time, China is struggling to revitalize its own growth after the job losses and shocks brought by the pandemic. The International Monetary Fund, IMF, and some investment agencies have already downgraded China's growth forecast for this year to 4%. Millions of export-oriented jobs are at risk. Nevertheless, Chinese authorities believe that the economy will continue to recover in 2024 and that the 5% growth target can be met. In sum, amid global trade turbulence, China's ability to attract investment from international giants highlights its resilience and strength. By fostering innovation, promoting green development, and deepening cooperation, China is weathering the tariff storm and becoming a pillar of global economic stability. In the short term, the US tariffs are only tying companies more closely to China rather than diverting them. Toyota and other giants are building a new headquarters in the heart of Asia with long-term strategic investments, not just a temporary solution. The movement we are seeing today is not just the result of a trade war. It is a harbinger of a reshaping of the global balance of power. As China continues its recovery despite the pandemic shock, companies are competing to consolidate their position in this giant market. In the coming years, it seems inevitable that Asia, especially China, will become even more dominant as a production and technology hub. And the fastest and boldest in this race will be the new leaders of the global economy. What do you think about this? Does the fact that Japan's major automotive industry has chosen China over the US show the failure of Trump's protectionism strategy? Or are there more complex dynamics at play here? Is China gaining an even more advantageous position in the trade war by attracting not only Japan, but also other global giants? Or, at the end of the day, will all these moves make global trade even more complex and risky? Don't forget to share your comments with us. This debate is very relevant to the future of the world economy. If you subscribe to our channel, turn on notifications, and join our live broadcasts, you will receive the most up-to-date information on these and other topics. Take care until we meet again next time.